Welcome to Learning with Tembi. It's your economics teacher here, Tembi Nezengane. As we continue with our learning program, we have arrived to our fourth lesson. It is still under the branch of economics known as macroeconomics, and this still forms part of grade 12's economics paper 1. From our previous lesson, we have learned that GDP is the most common national account aggregate used by the South African Reserve Bank. And we also stated that we've got three methods of which we can use to calculate the GDP. And that is the production method, the expenditure method, as well as the income method. But before maybe we go in depth with the GDP calculations, maybe we should ask ourselves why the GDP matters. Why is it important? And one of the reasons is that the South African Reserve Bank uses the GDP to measure the performance of the economy. In other words, the GDP enables the central bank, which is the South African Reserve Bank, to judge whether the economy is contracting or expanding, and in that way it will promptly take necessary actions. Secondly, economic performance will direct policy making and decisions made by the government, and not just by the government, but this also helps investors to take their own investment decisions. It also allows policymakers and economists to analyze the impact of other variables that may affect economic performance. Thirdly, economic growth is measured by the changes in a country's GDP. So we use the GDP to measure economic growth. And one might ask themselves what economic growth is. What exactly is economic growth? So economic growth is an increase in the production of economic goods and services compared from one period of time to another. So economic growth speaks to the increase in production and increase in goods and services produced within a country. And one thing that you have to know about economic growth is that economic growth leads to economic development. So one can ask themselves what the difference is between economic growth and economic development. And like I have said, economic growth is an increase in production, whereas economic development is an improvement in the standard of living of people. So when there is an increased production speaks to an increase in employment. And if people are employed, then their standard of living will be improved as well. So economic growth does lead to economic development. Now, in our approach to calculate the GDP, there are key concepts that I would like us to familiarize ourselves with. The first one being the GDP itself. I am bringing that up to ease the confusion that may exist between the GDP and the GNP. Like we have already said that the GDP is the total market value of all finished goods and services produced within the borders of a country in a given period of time. So we have another concept which is known as the GNP. And the GNP refers to the value of all finished goods which has been produced by the permanent residents of a country. So the GDP here is referring to domestic production, whereas the GNP is referring to the national production. But maybe to extend the explanation that I've just given now, we might say that the domestic production is referring to the production that has happened within the borders of the country, whereas national production is referring to the production that has been made by nationals of a country, or we may say by permanent residents of a country. If maybe I can give you an example on this one, we may have South African businesses or entrepreneurs or service providers or individuals who are operating across the globe. So the value of the production made by this group will be included in the gross national product of South Africa. And as they send money back to South Africa, this will contribute to the South Africa's gross national income. And another thing with regards to the gross domestic product, we are including the production that could have been made by a foreign business within the borders of South Africa. I hope that makes sense. So our third concept that we need to familiarize ourselves with is the factor cost. And the factor cost is referring to the cost of factors of production which have been used to produce goods and services. So this is actually referring to the value or the income that has been received by the factors of production which were invested in the production process. Then fourthly, we've got the basic prices. And the basic prices are the prices of goods and services after the tax on production has been added to the factor cost and the subsidies on production has been subtracted on the factor cost. So basically, the basic prices are equal to factor cost plus tax on production minus subsidies on production. And if maybe I can add on this one, we can say the basic prices are used when calculating the GDP using the production method, and they represent the production cost of firms. So lastly, we've got our market prices. The market prices are referring to the prices of goods and services after both taxes on production and tax on products have been added on the factor cost, and also both the subsidies on products and subsidies on production has been subtracted on the factor cost. So what happens on the market prices is that the market prices are actually the prices which consumers pay for, and this is calculated using the expenditure method. So all the taxes here are added and all the subsidies are subtracted from the factor cost. So if we are to find a formula to calculate market prices, we will say market prices are equal to factor cost plus taxes on production plus tax on products minus subsidies on production minus subsidies on products. So we subtract all the subsidies and we add all the taxes to the factor cost when calculating the market prices. Now that we have mentioned taxes and subsidies, maybe we shall get down to explaining what they are. A tax is a compulsory payment which is imposed to citizens by the country or by the government, whereas the subsidy, on the other hand, is a financial grant or other support from the government. So we've got different kinds of taxes as well as different kinds of subsidies. On taxes, we've got taxes on products as well as taxes on production. When we talk about taxes on products, we are referring to taxes which are levied on each item produced. An example of that can be the value added tax, a tax on exports as well as import duties. Then on the other hand, we also have taxes on production. And these are the taxes which are not linked to a specific goods or service, but rather it is linked to the production. This may include the pay as you earn, which is your income tax. It may include the tax on land as well as business licenses. Then on the other hand, we've got subsidies on products. And these are subsidies which are made on each item produced. It is linked to a specific product. So there's a direct payment by the government to the producer to decrease the price of such a product. An example of that can be the bread subsidy. Then we've got subsidies on production, and this refers to the subsidies that are not linked to a product but to the production process. And this may include an employment subsidy, which can be maybe a learnership, or subsidies paid to prevent pollution. With all this being said, now let us use the production method to calculate the GDP. If maybe I can take you back to grade 10 economics, we have all learned that in the production process, we have three main types of industries involved, and that is the primary sector, which involves the extraction of raw materials, and this can include activities of mining, fishing, forestry, you name it. And then we also have the secondary sector, which involves manufacturing of raw materials to useful goods. And lastly, we've got the tertiary sector, which involves commercial services that support the production and distribution process. So if you can take note of the production process itself, you will realize that as raw materials move from this primary sector to the secondary sector, as they get transformed to useful goods and services, there is some value which is added to them. And also when they move from the secondary sector to the tertiary sector, some value is added to them. So it is for this reason that the production method is also known as the gross value added method. Now, which formula do we use to calculate the production method? We are going to include the value which is added from the primary sector, then we add the secondary sector value added, then we add the tertiary sector. That is going to give us the GDP at basic prices. And I want you to also note that the GDP at basic prices already includes other taxes on production and also the subsidies on production. So after that, we are going to add the taxes on products and subtract the subsidies on products, which will give us the GDP at market prices. So what is also important at your level right now is to be able to convert the basic prices to the market prices, or to convert the market prices to the basic prices. So if you want to convert the market prices, the basic prices to market prices, you're going to say market prices is equal to GDP at basic prices plus taxes on products minus subsidies on products. Then the other conversion will just be the opposite. If you want to convert GDP from market prices to basic prices, you will then say GDP at basic prices is equal to GDP at market prices minus taxes on products plus subsidies on products. So I will give you a practical example of this with figures involved so that we can have a better understanding of how to use the production method when calculating the GDP. Now, let me give you an example of how you can be asked to calculate the GDP using the production method. Now, here's a question. It says, use the following information provided by the South African Reserve Bank to calculate the GDP at basic prices as well as market prices. So the information that you're given here, you can see you've got the income from all sectors of production, which is the primary, the secondary, and also the tertiary sector. And another information that you're given is the amount of subsidies and the value of taxes. So you always have to remember the the formula that you have to use when calculating the GDP using the production method. Here's the formula that I have presented to you in the previous slide to say that when you're calculating the GDP at basic prices using the production method, you have to add the values of all the sectors of production. And also, if ever you want to calculate the GDP at market prices, you then have to add the taxes on products and subtract the subsidies on products on the GDP at basic prices. So this question is actually asking you two questions in one. One is the GDP at basic prices, and the second one is the GDP at market prices. Now, this is how you're going to answer it. Your first answer will be the GDP at basic prices, because we know that for you to calculate the GDP at basic prices, you have to add the values of all the sectors of production. So the value of the primary sector income from the primary sector is 27,900 million rand. Then you're going to add the secondary sector income, which is 80,000 million rand, and then you will add the tertiary sector income, which is 120,000 million rand, and that will give you a total of 227,900 million rand, and that will be the GDP at basic prices. So your second answer now, you will have to now calculate the GDP at market prices. And we know that when you calculate the GDP at market prices, you then have to add tax and subtract subsidies on the GDP at market prices. So your second answer here will be the 227,900 million rand, which is the GDP at basic prices. Then you add the 110,000 million rand, which is your taxes, and you subtract the 55,000 million rands, which happens to be your subsidies. And the total of your GDP at market prices will be 282,900 million rands. So another thing that you have to take note of is that a question might sometimes not be specific as whether you're supposed to calculate the GDP at basic prices or the GDP at market prices. But the question might simply say, use the information to calculate the GDP using the production method. And you know that for you to get to the market prices, you must know the value of the basic prices. You are still going to use the same approach to answer the question. And it doesn't matter if you use it in this form or maybe you answer it in a table form. It really doesn't matter as long as you show all your calculations and you insert all the values which are aligned to the income on primary sector and the income on the secondary sector, the subsidies and the taxes. And that is how you get to your answer. Now, the second method that we can use to calculate the GDP is the income method. And the income method is where the GDP is determined by calculating the income and from the factors of production within the borders of the country. So, to show that a figure has been calculated using the income method, we can label it as the GDP in brackets I, or we can call it the gross domestic income. So just as the value of income should equal the value of production, the GDI should be also equal to the GDP, particularly when the GDP is calculated using the income method. So there are three steps of calculating the GDP using the income method. So we can calculate the GDP at factor cost, then we calculate the GDP at basic prices, and also calculate the GDP at market prices, and that is where we get our GDI, or the gross domestic income, like I have said. So calculating the GDP at factor cost, it only means that we are adding the factors of production. So this includes the amount of natural resources and capital that has been used up, the salaries and wages that have been paid to workers, and the profit that has been made by entrepreneurs. So if you can just take a look at our formula there, the formula that we use to calculate the income method, you can see that we seem to have new concepts that we have never discussed in our previous slides. First one being the compensation of employees. This includes the gross salaries and wages that are received when labor has been invested in the production process. Then we've got our net operating surplus, which simply means the profit, and this is the total value of all goods and services produced after the costs have been subtracted. So the net operating surplus is actually the remuneration for entrepreneurship. And lastly, we've got the consumption of fixed capital. And this is the depreciation in the value of fixed assets that occurs during the production process. Now, let us look at an example of how a question can be posed asking you to actually calculate the GDP using the income method. Here's a question. It says to you, use the following information provided by the South African Reserve Bank to calculate the GDP at factor cost, the GDP at basic prices, and the GDP at market prices. And these are the information, or this is the information provided to you. And we all know that the formula for you to calculate the GDP using the income method looks like this. So you have been provided with the taxes on products together with the subsidies on products, the salaries and wages of households, the total profit of businesses, the consumption of fixed capital, and taxes on production together with the subsidies on production. So the formula that I have provided to you to say this is the formula you use to calculate the income method. We said you will add the compensation of employees. And by compensation of employees, we are actually referring to the salaries and the wages of households. Then we've got net operating surplus, which we said it refers to the profit of businesses. Then we've got our consumption of fixed capital. So we are going to say GDP at factor cost is equal to compensation of employees plus net operating surplus plus the consumption of fixed capital. And the total is going to give us 670,000 million rand. And it is important to show all the calculations. Our second answer should be responding to the GDP at basic prices. And for us to calculate the GDP at basic prices, we must know the value of the GDP at factor cost, which we already have by now. So we're going to say the GDP at basic prices is equal to the GDP at factor cost plus the other taxes on production. Now we are going to include these ones. And we will subtract the subsidies on production, and that will give us, of course, we're going to substitute the GDP at factor cost by 670,000 million rand. Then we add the taxes on production, which is 60,000 million rand. Then we subtract other subsidies on production, which is of the value of 15,000 million rand. And the total thereof of the GDP at basic prices is going to be 715,000 million rand. Then our last part of the answer will be responding to the GDP at market prices, or you can just say the gross domestic income. And we are going to say the GDP at market prices, or our gross domestic income, is equal to GDP at basic prices plus taxes on products minus subsidies on products. So already now we've got the value of our GDP at basic prices, which is 715,000 million rand. Then we are going to add the taxes on products, which is the value of 45,000 million rand. Then we will subtract the 25,000 million rand of subsidies on products, and the total value of our GDI, or of our GDP at market prices, will be 735,000 million rand. Like we have said that we've got three methods of calculating the GDP. So the expenditure method is our last method for calculating the GDP. And this is where the GDP is determined by calculating the total expenditure on all final goods and services within the borders of the country. So we are looking at expenditure made by the participants of the economy. That is the expenditure made by households, the government, the businesses, and also the foreign sector. So if you can check here, We do not have GDP at factor cost. We do not do any calculations of the GDP at basic prices, but we do have the expenditure or GDP at market prices only, and also the gross domestic expenditure. So by gross domestic expenditure, we are referring to the total value of spending on goods and services within a country. So this is the expenditure which has been made by the participants in the closed economy. So this excludes any expenditure that could have been made in the foreign sector, be it through exports or through imports. So the first thing that we are going to calculate when calculating the GDP using the expenditure method is our gross domestic expenditure. And that includes consumption expenditure by households, which is represented by a capital letter C, and also the gross capital formation and change in inventories, which is represented by a capital letter I. By gross capital formation, we are referring to all the investment spending by businesses on capital goods. And then we've got a change in inventories. Maybe I should explain what inventories are before we talk about the change in inventories. So inventories, we are referring to either raw, semi-completed or completed goods owned by the business. So when there's a change in inventory is when there is a change in ownership of these raw, semi-completed or completed goods. Is either they could be bought or sold. We also have another item which we include when calculating the gross domestic expenditure, and that is the residual item. The residual item allows all errors that may have occurred in order to balance the gross domestic product or the gross domestic income equation. So if you're required to fill something in as a residual item, you will be given the amount. It could be positive or a negative number. So another thing is that if you are not given information on the residual item, you should not include it in your calculations. You should not add it at all. Or you can just add it as part of the formula and include it as a zero because you are not given any information on the residual item. So lastly, for you to calculate the gross domestic product at market prices using the expenditure method, you then have to add exports and subtract imports from the gross domestic expenditure. Now we're going to look at an example of how you can answer a question on expenditure method when you are calculating the GDP. Now, here's an example of a question related to the expenditure method. It says here, use the information provided by the South African Reserve Bank to calculate the GDP at market prices. And this is the information that you're given. You are given the consumer spending by households and its value, the investment spending by businesses and its value, the government spending with its value also. Spending by foreigners on South African goods, you must understand that by that they are referring to exports, and also we've got spending by South African on foreign goods, and that should be referring to imports. So please do remember whenever you want to approach this kind of a question, remember the formula that is used to calculate the GDP using the expenditure method. So here is our formula. It says here the GDP, we will first have to calculate the gross domestic expenditure for us to get to the expenditure on GDP at market prices. So we then have to add the consumption expenditure by household and investment spending by businesses, and also the government spending for us to get the gross domestic expenditure. And as you can see with the information that you're given here, we do not have the residual item. As a result, when you are calculating, it is not necessary to include it in the formula. So even if you include it, you're just going to substitute it by a zero because it is not provided. So our first answer here will be responding to the gross domestic expenditure and its value after adding the consumption expenditure by household and the investment spending by businesses together with the government spending. It will give us a 670,000 million rands. Then the second answer, which is now responding to the main question, which is responding to the gross domestic product at market prices, will then add the gross domestic expenditure, which we have got from our first step of answering this question, and then we will add exports and subtract imports. We are given that the value of our export there is 100,000 million rand, and then the value of our imports is 150,000 million rand. So when that all has been inserted, we are going to get 620,000 million rand as our answer, or as our gross domestic product at market prices. Another thing is that you have to know that if ever our exports and imports are equal, or the value that is spent on imports is equal to the value on exports, it therefore means that the gross domestic expenditure will be equal to the gross domestic product at market prices. Another thing that maybe you should take note of is that sometimes questions may not necessarily ask you to calculate the GDP, but rather you might be given a worked out GDP and be asked to identify which method has been used to calculate the GDP. So you should be careful of what information is provided. If ever you are provided with information like the gross domestic expenditure, you just know that this is the expenditure method. If you find the calculation including the factor cost, you would know that that is the income method, because that is the income method is the one which only speaks about the factor cost. And also, when we're looking at the production method, you know that the main components of the production method would include the primary sector, the secondary sector, and also the tertiary sector. One thing that you should take note of is that any information with regard to the GDP will depend on the South African Reserve Bank quarterly bulletin and also the publications from the Stats SA. So those are the two institutions which we depend on with regards to information on the GDP. This is sometimes asked in your exams to actually name the institutions which provide information on the GDP, and your answer shall either be the South African Reserve Bank or the Stats SA. If maybe I can add something on that, is that we cannot ignore the fact that the COVID-19 has negatively affected the GDP of South Africa and the world economy. So according to Stats SA, South Africa's economy has suffered a significant contraction when the country was operating under lockdown restrictions in response to this pandemic. So GDP fell by just over 16% between the first quarter and the second quarter of 2020, and this gave an annualized growth rate of negative 51%. And according to the South African Reserve Bank bulletin, this lockdown contraction in 2020 was the second largest annual contraction since 1920, when the GDP fell by 11.9%. So this information, I'm providing it to you as future economists or aspirant economists to analyze the current situation of South Africa and also try to come up with solutions as to how can we help the economy recover from this contraction. We have come to the end of our lesson today, and this has been a very long one compared to others. So our next lesson is going to cover the conversions and also the multiplier. Please do turn on those post notifications so that you can be notified when I post my next video. Thank you for tuning in, and I hope you enjoyed the lesson. At this point, I shall believe you are able to understand the concept of GDP, and you can now apply the three methods of calculating the GDP. Should you wish to be assisted further on this topic, please do not hesitate to send an email to tembinezingane@gmail.com, and I will be willing to assist you. Thank you once again.